it's a great topic because we have this inverted yield curve. Short-term rates are much, much higher than, on a percentage basis, than even 10-year rates. And so the yield curve, all that means is that the Fed funds rate right now is averaged out is 2.375. But the 10-year U.S. Treasury pays about 2%. So that's, the 5-year pays about 180, 185. So short-term rates are higher than near-term rates. And in headline risk, that has pointed in past times when that happens to a coming recession with varying degrees of accuracy and varying degrees of timing that actually pans out. So it's like I can say today there's a recession coming, and when it shows up in 38 months, I can say, see, I was right. So it's a little bit of a false positive sometimes. When I pan back and look at where are we with interest rates now, and I'm going to make a bold prediction that maybe Steve will write about this. But what I think the Fed should do on their July 31st announcement is take away the range of 225 to 250 and say the Fed funds rate is now 225. It'd be the first 13 and a half or 12 and a half basis point cut in the history of the Fed. So just make that the target and work off of that 225 number. It would gravitate short-term interest rates in the direction that the yield curve and the economists think that we should move. But let's step back from there, and this is my closing point. John F. Kennedy's Fed funds rate was 3.5. We're going back an awfully long ways, and it's only been below that subsequent to the 9/11 terrorist attacks. So a sub 3% Fed funds rate is a very new anomaly in our current economy. And I would ask Steve for some comment on this. A short-term interest rate or a prime rate of 5 is not getting in the way of a good investment idea, a good business idea, a good expansion idea being put into implementation because they wish interest rates were 25 basis points less. We're at all-time 50-year historic lows in what it costs to borrow money, and the banks are willing to do that. If I can hand you the mic, you could say something about that. That is not getting in the way of further economic expansion. People aren't going to sit on their hands. They probably are going to sit on their hands waiting for something to play out with trade, and we don't have an election in the next year, it's after that, so it may very well be 1 year from now, trade is still on the headline, and that's one of our headwinds, but it's not interest rates.
I was a banker back in my younger days, and interest rates, as I recall, prime rate was around 6 or 7%, and then in the early 80s, it went up to 20 or 21%. And that was a pretty difficult time for business owners, both farm owners as well as corporations. And if a company can't make money borrowing at 10% or less, they're not a very good company. I mean, if you think about that, and our prime rate is around 5, and it's likely to drop if the Fed drops the Fed funds rate. So I think there's plenty of opportunity here for companies and farmers and others to continue to grow properly and leverage appropriately, and interest rates I don't see getting in the way for a very long period of time unless something happens with inflation. And right now inflation is under 2, it's like 1.5. So it would have to go up dramatically, and I'm not exactly sure what would cause that to happen unless we had some kind of a crisis around the world. We can't, any of us, operate our day-to-day lives, regardless of the business we're in, thinking about that going to happen. So I think interest rates are not an issue. Chris, what I would ask you very quickly to address, I don't know how many of you here are interested in this, but Chris said our 10-year treasury is 2%. I believe in Japan and a few other countries, their long-term treasury rate is actually negative. They have people actually invested in negative long-term bonds. Can you address that, Chris?
I can address it, but I can't explain it. So, Germany is a stalwart economy. It's basically the strongest economy within the Eurozone. If you give the German government $10,000, they guarantee you that of 10 years, they will give you $9,950 back. That's it. But people have to park money somewhere. China has to park money somewhere. We are actually globally at a pretty high interest rate. Spain doesn't pay much more than the United States does to borrow money for 10 years. And I don't think that we're on par in terms of as a world economy. I know we're not on par with Spain. I don't have the mathematical or the economic answer for that, Steve, but interest rates is not in the way of progress around the world. What it probably does go back to is the expected rate of inflation. Because there's not a great forecast for we're going to go through a huge spike in inflation. We do a lot of domestic oil production. OPEC is only about a quarter of the world's oil production now. That's very different than in the Carter administration when you get gas lines and you get a commodity spike. We have the ability to control that a little bit more. Technology eats inflation for breakfast. And there's millions of smart people that get up every day and think about the next technology invention, and that's technology within farming, it's technology within finance, and that just keeps costs down and inflation down. And just the simplest example is, what's a big screen TV cost? What did it cost 3 years ago, and 3 years before that, 3 years before that? So technology eats that inflation for lunch. We just don't have a big forecast going forward, but interest rates should be higher because inflation